All right, let's dive right in. Welcome to our latest explainer where we're jumping into an absolute heavyweight clash in India's booming 1 lakh crore rupee diagnostics market. In one corner, we've got the reigning legacy champion, Dr. Lal PathLabs, and in the other, the agile, fast-growing challenger Metropolis Healthcare. We are putting these two giants head-to-head today to see exactly which one deserves a spot in your portfolio. Welcome to Stress-Free Investing Analysis Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. Okay, so here's our roadmap for today's matchup. We'll start with the diagnostics battleground, then get right into the financial face-off. After that, we'll weigh their balance sheets and valuations, examine their moats and management, tackle AI disruption and sector risks before finally heading to the scorecards for our final verdict. Let's get to it. Section 1, the diagnostics battleground. Let's set the stage for this massive healthcare matchup. Right out of the gate, just look at the sheer difference in scale here. Dr. Lal PathLabs is sitting at a massive 26,611 crore rupee market cap, which is literally more than double Metropolis Healthcare's estimated 11,400 crores. But as we all know, size isn't everything in investing, right? Our base verdicts and stress-free scores are already teasing a pretty fascinating matchup. A 77 out of 100 buy on dips verdict for the heavyweight Dr. Lal PathLabs against a 68 out of 100 accumulate for Metropolis. Stick with me as we unpack exactly how we arrived at those numbers. Moving into Section 2, the financial face-off, let's dig into the actual numbers and see who truly dominates profitability and growth. When it comes to pure quality and margins, Dr. Lal PathLabs is asserting absolute dominance. They're pulling in 2,763 crores in revenue, compared to Metropolis's 1,646 crores. But you really need to pay attention to these margins. Dr. Lal PathLabs boasts a 27.2% EBITDA margin and an incredibly healthy 18.5% PAT margin. Now compare that to Metropolis at 24.4% and 11.5% respectively. And that return on equity, it's almost double, roughly 21% versus 11%. Dr. Lal is undeniably landing heavy blows here as the steady, dominant leader in pure profitability. Now here is where Dr. Lal truly separates itself from the pack. I mean, look at this staggering disparity in return on capital employed. We're talking about an incredible 44% ROCE excluding cash for Dr. Lal PathLabs. Metropolis is sitting at a respectable but much lower average of 16 to 18%. This just shows that Dr. Lal PathLabs is putting every single rupee to work with absolute masterclass efficiency. But hey, Metropolis isn't going down without a fight. They are the fast-growing turnaround challenger here. While Dr. Lal PathLabs has that steady, reliable growth, Metropolis just posted a massive 31.1% year-over-year EPS growth. Their 3-year revenue CAGR is also higher, coming in at around 16.6% compared to Dr. Lal's 11%. Metropolis is aggressively chasing growth right now, relying pretty heavily on recent mergers and acquisitions to fuel that top line. Round 3, balance sheet and valuations. Let's step away from the income statement and see how much safety and value each stock actually offers us right now. Incredibly, both of these companies are highly responsible with debt. They're essentially debt-free, which is exactly the kind of sleep-at-night safety we're always looking for. However, Dr. Lal PathLabs has amassed a gigantic war chest. They are sitting on 1,526 crore rupees in net cash, which completely dwarfs Metropolis's 255 crores in investments. That immense cash pile gives the champion incredible optionality moving forward. So what does this all mean for pricing? You'd normally think the higher quality company with the better margins would demand a much higher premium, but look closely. Dr. Lal PathLabs actually trades at a slightly lower trailing 12 months PE multiple of around 52x, compared to Metropolis at 56x. Plus, Dr. Lal offers a better free cash flow yield at 2.1%. Both show solid double-digit upside to our base fair values of 1,800 and 620 rupees, respectively, offering a lot of potential for investors. Next up, moats and management. Let's look past the spreadsheets for a minute and evaluate the real-world business models driving these numbers. Strategically, these two are taking very different paths. Dr. Lal PathLabs relies on a massive 75-year legacy, utilizing an extremely efficient, asset-light hub-and-spoke model with over 7,700 patient service centers. They lean heavily into their swath-fit wellness packages for customer stickiness. On the flip side, Metropolis is pivoting hard into its Metropolis 3.0 strategy. They are targeting high-end specialization, specifically focusing on oncology and rare diseases, all while maintaining a strong 65% business-to-consumer revenue stream to protect their pricing power. And management is absolutely vital to executing these strategies. We score them based on credibility and delivery. Dr. Lal PathLabs is founder-led, boasts a highly credible AA+ rating, and earns a really solid 4 out of 5 management score for consistent delivery over the years. Metropolis, led by chairperson Amira Shah, has incredibly ambitious guidance. They're aiming for a 14 to 15% CAGR. However, because of some historical margin softness over the prior 3 years, they score a slightly riskier 3 out of 5. Essentially, Metropolis is a turnaround story with something to prove, while Dr. Lal is the proven executor. Now for Section 5, AI disruption and sector risks. Because no explainer is complete without looking at the looming tech and macro headwinds threatening both of these contenders. Let's talk about AI. The fantastic news here is that AI is predominantly a massive tailwind for both of these businesses. For Dr. Lal PathLabs, AI is actively driving cost reductions in radiology and powering their GeneVolve genomics platform. For Metropolis, AI-assisted digital pathology and genomics represent a high opportunity vector. So rather than destroying these legacy players, AI is actually enabling precision medicine at scale and making them significantly more efficient. But we do have to take the macroeconomic threats seriously. The biggest overarching danger to both is the potential for government price regulation on core tests. Make no mistake, this could theoretically cap upwards of 30% of their revenues. They also face risks of EBITDA margin compression if lab expansion costs get too high, and both are constantly fighting off B2C commoditization from massive digital aggregators like 1mg, Tata, and Pharmacy. The sector is structurally growing, for sure, but the competition is undeniably fierce. Section 6, the final verdict. We've reached the end of the match. Let's go to the scorecards and synthesize all this data. Looking at the final tally, Dr. Lal PathLabs basically pitched a perfect game here, achieving a 100 out of 100 on our comparative rubric. They maxed out their balance sheet score at 25 out of 20, and yes, we gave them bonus points for that massive 1,500 core cash pile, and scored a dominant 21 out of 25 in profitability. Metropolis finishes with a very respectable 80 out of 100, lagging primarily in that profitability and valuation scoring against the industry leader. So what's the big takeaway from this explainer? Well, if you're a conservative investor seeking a high-quality compounder with an exceptional track record and superior capital allocation, Dr. Lal PathLabs is your clear winner. We give it a stress-free score of 77 out of 100, a grade A-, and a buy-on-dips verdict. But if you're a growth-oriented investor who's comfortable with a bit of execution risk, Metropolis Healthcare is a highly attractive turnaround story. We give it a stress-free score of 68 out of 100, a grade B+, and an accumulate verdict. Both are excellent companies. They're just suited for completely different investing strategies. Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a CB-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a CB-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing.